Hi everybody, this is Jeremy again. In this video, we're going to talk to you about why investors are losing money when they buy these products. Now, this is a serious but absolutely fixable market structure problem that's acknowledged by everybody. Auditors, asset managers, mutual fund administrators, exchanges. I've talked to them all. Everyone says, yes, this problem exists. The question is, well, why aren't we fixing it, right? So in this video, I'm going to talk to you about why you're losing money. It's kind of the mechanics and the mathematics behind why you're losing money. Okay, so first, I would just like to point out that hidden costs are prohibited as per our state and federal securities laws. So I have no idea why this business practice is being allowed to continue. Okay, global equity markets use what I call a last holder of record payment system to distribute income from securities to investors. Essentially what this means is that if you're the last holder of record on a certain date, you get the entire dividend regardless of how long you own that security. It's kind of a stupid way to do it, but that's the way that the system works. So for this system to function properly, the income a security generates must be included in the price of the security. In essence, financial distributions, which are payable liabilities, are treated as assets. This artificially inflates the prices of the securities you buy and causes you to purchase fewer shares and earn fewer dividends. Including dividends and other distributions in the price of the securities means that part of your invested capital goes towards purchasing these dividends and capital gains. This is what the industry calls buying a dividend, and it causes investor losses. Why? Well, when you buy a dividend, that dividend or distribution is ultimately returned to you when the dividend is paid. You bought a dividend and then it was returned to you. This is not income. This is a return of your capital. A return of your own money is not taxable under IRS rules. Unfortunately for you, our markets will treat that return of your money as a fully taxable distribution. I'll say it again. The markets are going to treat the return of your capital as a fully taxable distribution. Bottom line, paying taxes you don't owe is a loss, and is perhaps the worst kind of loss, because it's not your fault. Me, I'd rather lose money in a casino than pay taxes that I don't owe. You're going to lose money on the first dividend, the first long-term capital gain, and the first short-term capital gain you receive. So you can have multiple losses when you buy one of these securities. Now, this is a massive problem. This is the biggest problem facing investors ever in my lifetime, and I'm 40 years old. Okay? Luckily, this can be fixed. I mean, FairShares has built the software needed to fix this. However, when we talk to Wall Street, what Wall Street tells us is, and I've talked to everybody, by the way, I mean, every strategically important firm out there. What Wall Street says is, well, Jeremy, we're not getting any customer complaints about this. And I say, well, no kidding. Nobody knows it's happening. But as soon as people know it's happening, I can assure you the complaints are going to start rolling in, because if there's a problem that's costing people money and there's a viable fix just sitting out there waiting to be used, people aren't going to be okay with that. So the way that you can help me and the way that you can help yourself is to subscribe to this channel, like this video, ring the bell, and then take these videos and spam them all over your social networks, because when people see these videos, they're not going to be okay with this, and that's going to drive the change. Okay, I hope this is starting to make sense. In the next video, what we're going to show you is the mechanics of a loss, like a real trading example, kind of show you how that math works so that you can understand that these losses are real, and it'll begin to give you an idea of how to calculate this yourself. So stay tuned to the next video.